Welcome to the Real Estate Jam session. Today we're going to be talking about retirement. How do we get there? How do we set ourselves up for getting there? So Eric Martel comes on the show today, and Eric has been a podcaster. He's a contributor on Forbes. He's been around the business for a long time and really walks us through the path to get there. So make sure you check out the video and like it while you're there. And if this is the first time you've been on this channel, my name is Joe Killinger. We're really happy to have you here. I've been a real estate entrepreneur for over 20 some years, and I use this YouTube channel to really bring people like Eric on to walk you through a path to success. So we go through what has worked well for them, what they've done and failed at, and what they learned from that. So make sure you check out the video, give us a like, and while you're there, make sure you subscribe. All right, Eric. So, it's something that, retirement always sounds good, right? Especially after the last few years of not having to do a whole lot. And I kind of got spoiled. So I'm pretty much ready to retire in my own mind, but financially that's not true. But today we want to talk about how do we get that path to retirement? How do we get there? How do we get there the fastest? Could you kind of walk us through your vision of, what's the path that we should be taking?
Yeah. Well, the other thing too that I wanted to mention is that, retirement is really something that's inevitable, right? So at one point in our life, we're going to have to stop working. It depends what time it's going to be. Some people are thinking it's going to be 65. Some people are already, like yourself, at 40.
Yeah. It got me thinking, I prefer retirement compared to whatever else there could be on the other side, right?
Yeah. And then also now with the way the economy is working, the more gig economy, we have to be prepared also for potentially a reduction, I'm thinking, of income. Right. Household income, and also gaps in income, something that people are not familiar with. If you haven't been an independent contractor, you could have gaps in income when you change projects and stuff like that. So when we go into the gig economy, so these are all kinds of things. And this is why I'm saying that the number one goals for everybody should be to achieve financial freedom. And I looked at all kinds of different ways to achieve that. You can invest, you can, do like covered calls, you can do, all a bunch of stuff on the stock market, but these are pretty active kind of methods, and you need to have certain skills to get there. And you're also putting, a lot of capital at risk. You can actually decrease your equity in some of these markets if we have a market crash or something like that.
Oh, yeah. I think that there used to be an old joke that the guy used to be Fred Sands Realtors. Fred Sands used to say, when a residential agent or a commercial agent retire, when they die. He goes, because we never think about when am I going to retire? And I think it's something, I don't care what age you are, and maybe you have a number that you like to talk about when you should start saving for retirement. But I think, in your 20s, you want to be, it's just a lot easier, right? Put a little bit of money away, and then as you get older, Absolutely. Keep adding to it and investing for it. You got to be thinking about the future and your family's future. And I'm probably one that's guilty of it myself. I didn't really, I was always thinking, grow the business, invest back in the business. But you also have to think about, what if, information and fantasy, right? What if,
Yeah.
So.
Yeah. Yeah, people think they're I'm going to retire at 60, I'm going to retire at 65. The thing is that people don't know when they're going to retire, because right. Most of the time, I think it's only like 10% of the workers out there are actually retiring at the age that they want to retire. Often it's a crisis in the family. They have to take care of a loved one. They got early termination from a job, and then they can't find the same job at the same salary, so they find themselves in an awkward situation. And so people don't find they think they know when they're going to retire. The problem is that most of the time they're going to retire even earlier than they think. And sometimes it's too early, and you have your money stuck in the 401k, and then you have to pay penalty to get the money out. It's not pleasant.
Right. Go ahead.
Yeah. So that's why I'm thinking, when I'm looking at this and I'm looking at all the different vehicles that you can use for achieving financial freedom, you obviously have to build a passive income portfolio. So something that's going to generate income that typically people say, well, I want to make money in my sleep. So that's kind of that kind of investment that you're looking for. And after looking at all the different methods of doing this, really real estate rentals is the ideal way to generate passive income, because you can delegate most of the things to other people, to project management company, to have contractor. You don't have to swing any hammers. You don't have to clean any, unplug any toilets or anything like that. You can delegate a lot of that work to other people. And you can, you just approve work orders and you say, okay, fix this, fix that. And so that's the ideal way, in my opinion, to get that done. You can get truly passive and you have leverage, you have all kinds of other benefits associated with that, tax advantages, depreciation, you have leverage and all that kind of stuff.
Yeah, I love to see, and it's a little harder to get into, right? Is the triple STNLs, the fast food franchise or pharmaceuticals, and but that takes a while, right? That's about as passive as you could get, but it's also the easiest to get out of, So on your portfolio diversification, what do you have suggestions on how you should diversify your portfolio?
For me, I'm thinking single family rentals is the ideal way to get in. And then that allows you a couple of things. So that allows you, first of all, it's easy to ramp up. You can get started with as little as, maybe $30,000 down payment on a property in the Midwest, these are the ideal markets if you're looking for cash flowing rental properties in landlord friendly states.
Right.
And so with that, then after you have that one property, then you can decide to diversify into other markets. Maybe you buy a house, one or a couple of houses in Cleveland, let's say, and you buy a couple of houses in St. Louis, a couple of houses and you diversify your portfolio that way. It's also good to have, so that's going to generate quite a bit of passive income. And that's what I'm hoping that people would get their passive income from that. Then you have to have some liquidity, obviously some savings on top of that. If you're truly going to be, passive and retire, then, you may want to have like an extra, 20% or 10% kind of cushion, depending on how comfortable you want to be, but another 10% on top of that to have in case there's something happens, in case you have a medical expense that, and you have to keep that pretty liquid. That's my suggestion.
Yeah. The now, when you say single family, do you think single family homes or have 2 to 4 or something like that, or a mixture of 2 to 4s in single family homes? Because if you've got a home back in Ohio and it goes vacant, you're paying full pop on that mortgage. Do you think it'd be better to diversify your portfolio with a little bit more of the 2 to 4s or something like that with essentially the same loan?
Yeah, absolutely. That'd be ideal. If you can find typically the return is actually better. So if you can find that, so anything residential, it's a good way to get in 2, 3, 4. Why I don't really mention it is because we can't find that many of them. So there's plenty of single family rentals, but if you focus too much on duplex, then you're never going to get in.
Right.
Well, you will, but it's going to take a long time, right? So, and then I have some people that say, oh, they just want to invest in fourplexes. Well,
right,
good luck. Yeah, you can. Yes, the returns are going to be higher, but then you're gonna take you like 6 months, 9 months to find that. So it's going to be pretty difficult.
Now you're looking at you're pretty much strictly cash flow. You're not appreciation game, right? Well, maybe a little bit right now, and depending on where you're at in Ohio or California, obviously, but there's so much competition to buy assets down here. It's got to be.
In the last couple of years, we've seen incredible appreciation. But when I'm putting assumptions, if people are looking on my website, we include, in terms of the returns, we look at the cash flow. So all of our properties have positive cash flow, but on top of that, we add a little appreciation component. And on average, our appreciation assumption is 3%, right? I'm looking at what happened in appreciation over the last, since 1980. So that's kind of my assumption. And in the last couple of years, what we've seen in the markets where we invest is more around 15 and 18% appreciation. So obviously, I'm not going to use that as a number moving forward. I don't believe this is going to last forever.
Right.
I'm assuming 3%. And I have people that bought a house like a couple of years ago, and now they refinance, they do a cash out refi and to buy a second home. Yeah. So that's great for them, but it's not a realistic scenario, moving forward if you're looking in the future.
Yeah. And so you're focused on more of, in California, we got the eviction moratorium, I think goes through 2023, right?
Well, so the markets where I invest, I don't have the eviction.
You don't have anything here? Okay.
No, that's right. So this is why I invest in landlord-friendly states. Right. So I was talking to an investor friend of mine, and he has some properties right here downtown LA. He has apartment buildings, and he hasn't been able to raise the rent for the last 2 years, and and potentially he won't be able to raise the rent for the next 2 years. Well, he's affected by inflation the same way everybody is. Yeah. So inflation it's way more than 8%, by the way. It's more, and depending on how you spend your money, it could be as high as 20%. Yeah. But but he's affected by that. But he can't raise his rent, so he's pretty upset. We've been able to raise our rent, no problem. We've been able to evict tenants that were not paying. We didn't have any issues with that.
Yeah, I heard this is a horror story for you, is just over the weekend, I was talking to a residential agent east. I don't think they're quite the Inland Empire, but pretty close here in Los Angeles or East Los Angeles. And they sold a house, and the tenant had gone through, or the previous owner had gone through the whole process of making it look like everything was boxed up, ready to move. The property closed, and then they never moved out.
Oh, really?
Yeah. So now they've got a situation where previous owner is living in there, cannot be evicted, and now they're paying for a mortgage. I mean, the new owner's sitting there paying for a mortgage. So a lot of tricksters out there. You got to be careful.
Yeah.
Make sure they're out the door before you sign on the dotted line.
Yeah.
Have you guys seen any of that? I guess with the state you're investing, you're not seeing any problems with getting people out. So
we we don't have any problems. I mean, we have to go through a process. It's not like, it's not like the Wild West or anything like that, or the Wild Midwest. It's, we have to go through a process, but our process for evicting a tenant is going to be 30 to 45 days. So now how are you finding your deals, Eric? You just have a connection from being in the business for years. You have all these people, So we do have some of that. We also have a wholesaling company that is sending deals our way. So we started that a couple of years ago. It's called Rocket Offer, OFFR. Okay. And so they're sourcing deals for us. We buy deals from them. We buy deals from wholesaler. About a quarter of our deals are actually coming from wholesalers. Then we have another quarter of our deals are coming from pocket deals from realtors. Yep. So people that know us and they say, hey, I have this portfolio of rental properties. So that's often when we buy portfolios of single family rentals, is that route. And then we have, believe it or not, MLS. Half of our deals is coming from MLS, but really? We respond. Well, we respond very quickly. Yeah. So again, today, like we have calls every day with acquisition team, and they had 30 deals today that they were looking at MLS, and these deals just showed up this morning, and they're going to put offers on some of them in the next couple of hours. So we're often the first one to put an offer in front of these owners. And their cash offers, we close quickly, just the same tricks that everybody's doing. But lots of deals still on MLS.
Are you seeing more deals come on the market?
It's been kind of on and off. So, but not too much. It's kind of maybe a little bit more, but not significant. We haven't seen like, oh my God, there's so many deals. It's still a seller's market.
Yeah, but it's changing fairly quickly though, right? Well, I don't want to say quickly, but it's starting to stabilize from what we're seeing.
Yeah, I think the thing is that with the increase in interest rate, that's kind of reduces the demand a little bit. So we have less people that are, that are potentially buying these properties.
Right.
So yeah, so that squeezes it a little bit. You would think that the for the owner occupied, yeah, so that would really reduce the demand on that side of it. A lot of the properties we buy, they're already investment properties.
Right. Okay.
So it's a little bit different, and then we buy cash, so we can, we can do some better
Now,
deals
Eric, do
there.
you guys buy cash and then refi?
We buy cash, then we resell. So we sell
Okay,
these
you just
properties
flip.
to,
Okay.
yeah, that's right. So we're helping people that want to build that passive income portfolio, that want to achieve financial freedom, retire early, or
Right.
just retire, leave a legacy for their children. So that's what we help investors do.
Now this is something I was in a conversation with last week with a guy that's buying, and he's buying around the Midwest, but he was buying all these single family homes around lakes and that kind of stuff, and Airbnb it out. And do you think that you're going to see I think that's going to dry up, right? Because if I'm middle America and at, $4 or $5 a gallon, I'm not going to be driving that far in my pickup or my, to go on vacation. And food, especially if you have a family. I think that's going to create opportunity for people who are doing what you're doing. Don't you think?
I think so. I think it will be. The advantage of these rentals is that you can do, if you want to do Airbnb, you could do that. They're obviously, my houses are not on they're for workers, they're workers housing. So for people that have a job, they want to be close to their jobs.
Yeah.
So it's not going to be in the lake somewhere. But I think in terms of Airbnb, I think there's always going to be a place for Airbnb. I think that I don't know if you've done a lot of Airbnbs, but there are significant issues with that model when you're actually going into the properties, and then the expectation of service and amenities is very different. I personally prefer to go with a hotel chain. And I know exactly the service that I'm going to get. I know the amenities very well. I know, all of that. And I know that if it's not good enough, I can complain to someone and then they're going to help me out. Airbnb, it's not that obvious that this is going to happen. And also the hotel industries, I mean, they're not stagnant either. They're very progressive, and they are creating also their own kind of versions of Airbnb for longer stay hotel guests that want to stay like 3 months, 6 months somewhere. So they're getting into that market. To me, I prefer that model because of the level of service that I know that I can expect, and I know that I'm going to have. So
no, I think as long as you're doing Airbnb and you're on the coast or in a tourist driven area, you're probably going to be okay. But I think there's some areas that they're going to feel it, and they're going to feel that, okay, I'm not going to be able to rent this out near as much, and they're going to take a bit of a hit in there. So they'd be better off doing exactly what you're doing, is flipping out and using that capital somewhere else. Let's talk about, how do you think, with interest rates going up in your business, I mean, obviously it's not going to affect you too much where you're doing cash, but are you thinking that what you're doing in the industry is there's just going to be more opportunity for you because there's going to be less people out there able to do it?
I think there's going to be more opportunities for me on the acquisition side. So that's going to help on the sell. We sell these rental properties, so it's squeezing a little bit the cash flowing margin. So that's where we're seeing a little bit of the effect. But it's still good buy. So instead of getting like 12% cash on cash return, now maybe you're getting 10% cash on cash returns. So it's too bad, but it's not that. It's a long-term gain. So people have to think about it. Like, they're not going to live on that $250 a month just yet. The idea is to build that passive income portfolio, take advantage of the tax benefit, and do all of that. And the key also is that if you want to beat the inflation, if you want to protect your money against inflation, we all know that leaving it under your mattress is not a good idea. If you just buy real estate cash, it's okay, but you have to basically exceed a little bit the return in terms of the inflation. So if the inflation is at 8%, because you're going to have to pay some taxes if you want to cash in or do something, you're going to have a return a little bit higher. The key is leverage. So you want to be able to leverage, you want to get a mortgage in there, and then you can, you really protect your purchasing power that way, because you're getting a loan today in today's dollar, and then you're paying it in tomorrow's dollars. That's going to be worth a lot less. So this leverage is key. And even if the interest is a little bit higher right now, I would just you want to buy as much real estate as you can, and you want to get a mortgage as high as you can as well. Not interest rate. I mean, loan to value ratio.
I was on a call this weekend, and some people are on Friday actually, and it was with guys from a couple of big banks in New York, and listening to them talk about, they said, yeah, the economy looks like it's stabilizing, slowing down, but commercial real estate is still a good place to be if you you invest properly. So it is great. Now, how long have you been doing this, Eric?
So we've this particular business, a turnkey rental model, we've been doing this for about 6-7 years now.
Okay.
Yeah, 6 years, 7 years. Yeah.
And how long you been in real estate?
In real estate, kind of on and off. Like my first apartment building I bought when I was 18 years old. So that's kind of I was still at university.
Young. Wow. Where were you at that time?
I was in Montreal at the time.
Okay.
So I was studying, I was at university still, and I was introduced to a real estate investor. I said, well, I want to learn everything you have to. I knew that I didn't want to have a full-time job, and you know, I knew it was not for me. I wanted to be a business person, and so this guy was just like a regular community college teacher, and he said, well, if he can do it, I can do it. I'm smarter than he is. as you think, you know,
we all do, right?
Every 18-year-olds think they know everything. So I was exactly like that. So
and the reason I ask you is how long, what's the highest interest rate you've seen?
Oh, in 1980, we had a house. We were doing house hacking before it was called house hacking, and our interest rate was 17%.
Yeah. So
and
see,
it was still good.
Yeah, that's why when they say, oh, 5%, I'm like, I've seen worse. Yeah. You know, and that's what I think we got to wrap our head around is the rates. And again, you know, we're going to go up a half point on the fourth, the way it sounds, but hopefully that's it. But, you know, we got to get our head around that. And, you know, it's really, we've had a really hard run, a really good run the last several years. So yeah, it's still a good place to be. I'm a firm believer in real estate, and what you guys are doing is amazing. Eric, how do we get a hold of you?
So the easiest way to get a hold of me is basically on Instagram or TikTok, Eric Martel Official. So that's a good way to get me there. I also have my personal website, marteleric.com. And of course, my website where we sell these turnkey rental is martelturnkey.com. So any of these methods is a good way to get a hold of me.
Perfect. If you can send me all those contacts, Eric, I'll make sure we'll put them down below on the video. Tell us a little bit about your podcast, Away from the Rat Race.
So Break Away from the Rat Race, I interview entrepreneurs and all kinds of people that have great ideas on how you can break away from the rat race and basically become financially free. So that's a great channel. So I talk to a lot of different. I'm a firm believer in real estate, but I also talk to some other individuals who are interested in stock market, and they have an interesting kind of ways of investing. So I'm not. I keep it open for people to do that. I also have a book called Stop Trading Your Time for Money. It's available on Amazon, where I basically talk about, you know, a plan for getting you to financial freedom.
Perfect. All right. Well, Eric, thank you for coming on the show today. I appreciate it.
My pleasure. Thank you for having me.
You bet. And for those of you watching, make sure you check out the video and make sure you like the video while you're there and DM with any questions. All right, Eric, have a good one. Thank you.
Yep. Thank you.